You know, having a new child, whether you adopt one or have one of natural childbirth, brings on many, many exciting and scary moments. But it also changes your tax return. There are things that you need to understand in the world of credits and deductions. We're going to talk about that today on Consider This Program. Well, good morning and welcome to Consider This Program. I'm your host, Joe Clark.
And I'm Ben Smith, CPA.
Happy to have you along, Ben. Hey, Ben is one of our partners. He's the president of Estep Doctor and Comany, an accounting firm based in Muncie, Indiana, as well as here in good old Anderson, Indiana, where we film and host this show. I've been working with Ben for 3 or 4 years, and we just have a great time, and it's a big part of our relationship that we have. There is a lot of things that happen to a tax return when you introduce that next phase of life. So you went from filing as a single individual, you got married, you went to a joint return, and then all of a sudden you have this bundle of joy, otherwise known as a child. And it creates some opportunities and a little bit of confusion for your tax return. So I brought my buddy Ben in, and I thought we would just talk about that quickly. So Ben, let's start off with something that not everybody understands. What is the difference between a deduction and a credit?
Sure. So the deduction is something that reduces your taxable income, and then the tax rate is applied on that taxable income. A credit is actually a refundable, sometimes not, but a credit is actually a reduction of the actual tax. So the credit is actually much better than the deduction in most cases.
So if you think about this, and it's what I used to always tell, that we used to talk about above line and below line deductions, right? A credit's like getting something above the line. It's a beautiful thing, and when you have that, you have great opportunity. So let's talk about a child, right? Let's bring him into the world first. So there's one of the big things that changed was the adoption credit, and you're familiar with that, obviously, in your own life. Talk about that.
Sure, very much so. So my oldest son, Evan, is 21 now, and 21 years ago we adopted him and his younger sister, Emily, she's from Guatemala, he's from here in Indiana. And so you have an opportunity to get a credit for those expenses that you outlaid to adopt the child. Medical expenses, even medical expenses paid for the mother, the birth mother, hospital stay, a lot of those things can be accumulated, and then you actually will get a credit on your tax return up to $14,660 this year of those expenses. Adoption expenses can be quite expensive. It can be more than that. It can be less than that, but certainly that amount you get a credit on your taxes, and it sure helps you bring those children that are in need of adoption and need of a home into your home.
Oh, wonderful! I'm glad you guys did that. That's a beautiful thing. So now that we've got the child. Now there's this wonderful thing called a child tax credit. What in the world is that?
Right. So in 2017-18, the rules changed. We used to make light of when you had a child come into your family. That was the new exemption. No longer are exemptions in existence. They eliminated the exemption. They increased the standard deduction for those that don't itemize to offset that. So instead of getting that deduction, we now get the better deal, the credit. It's $3,600 this year for a child under 6. And then I believe it goes up in 2021, it goes up to $4,000 for one child, up to $8,000 for 2 or more. So it's a much better deal. As I said in the opening there, a credit is a direct reduction of the tax liability as opposed to a deduction above the line. Now,
like all things, we're going to mention this nasty word called a phase-out. So first of all, explain what a phase-out is.
Right. So throughout the tax law, there are a number of phase-out provisions for income earners. So the higher income level you are, the more you make, they're going to take away some of those credits as you go forward. So depending on your income level, those credits can be reduced and phased out all the way down to zero if you're over a certain level.
So there is a phase-out, I'm sure, for the child care credit.
There is.
So it's not going to do me a good to go adopt a bunch of kids and bring home a school bus.
Right. Well, yeah. I mean, you could get the adoption credit for each of them, but then you've got all those lovely expenses that we like, fees and expenses, taking care of them for their lifetime.
So let's jump to the big expense that we know that's going to happen later in their life, and that's college.
Absolutely.
Or if you're going to a type of school that is private where you're paying a fee, there's a wonderful tax code called the 529. How does that work?
Right, absolutely. So it's a really, really good way to save for college and for the future of your children. Most of my clients will open these at birth, and they can put a few $100s a month. They can start out small. They can put however much in they want. And that grows. The interest grows. The earnings grow tax-free all the way up until they reach age of college. Now, there are some provisions for prior to college, school-age children, but the primary goal is to save for that huge number college, because it just keeps getting more and more expensive. So when they reach that college age and they enroll in an institution, you've gotten what you've put in plus the interest and earnings you've made on that helps supplement their tuition, room and board, any expenses really that are associated directly with the college education.
And the nice part about this one, Ben, is there's no income cap. So if you make $100,000 a year or $1 million a year, you can fund a 529.
That's correct.
Now, I want to be very, very clear about this. The one that we use in Indiana is called the Indiana College Choice. It is a little bit different than a 529. A 529 is a federal tax code, right? If you're in Indiana and you have an Indiana tax return, you can put up to $5,000 a year into this thing and get a 20% tax credit. In other words, $1,000 back into your billfold. And again, there's no income limit. So but I would also tell you never to do that through a broker or just go online to College Choice. There's no way for me to do it as a registered investment advisor. We have to charge a commission. That's insane. It's the easiest site I've ever seen in my entire life.
Absolutely, Joe. You're absolutely right. It's a very good way to do it. You go online. You can have parents, grandparents go online, give them the account. They can put the money in there. It grows tax-free. Up, as Joe says, 20% tax credit on Indiana up to a total of $1,000 credit. So if you put $5,000 in a 529 or a combination of children, grandchildren's 529s, you get that $1,000 max no matter how many you have. But it's a great deal.
Now here's where some of the planning goes into play. You've heard me say on this show many times that the tax code was not written in to be optimal through one tax code. So I used my mom's, I used my kids, and I used mine and Barb's to be able to get this done. And there was a period of time when we were using 529s when our kids were younger, and we actually made a gift to our in-laws, to Barb's mom and dad. At that point in time, you were allowed to give away, I think it was $13,000, maybe it was $12,000 a year at that point. But you can give $14,000 a year away to anybody that you want. 15
it's actually up
now,
to 15 now,
for
yeah.
2021. And there's no strings attached. And we actually made the gift. They were able to fund the 529 and got the tax credit that they were able to get. So it was like son-in-law giving a Christmas present to father-in-law. It was a beautiful deal.
Absolutely. If you take the money out early or don't use it for college, there is a penalty on that.
There's no way around it.
Which you don't want to do it. There is one way around it, actually, Joe. If you earn a full ride scholarship to anywhere, actually, if you earn a full ride scholarship, the amount of that tuition and fees, you can actually withdraw that same amount that you earned as a scholarship from the 529 and not incur the penalty. You'll still pay tax on the earnings, but you won't incur the penalty.
So that's sort of getting around it.
Sort of
getting around it. All right, there's one last thing that I love, and I've got to give you a full disclaimer. I'm going to ask Ben if you can do an IRA or a Roth IRA for a child with earned income. He's going to say yes, but I'm going to let him explain that. I'm going to tell you that not all custodians will accept taking the account, so you have to be aware of that as well. So I have a child. The child has earned income. What does earned mean?
Earned income means just what it sounds like. It has to be earned from a job, a wage-paying job, a W-2, or it could be self-employment income if they mow lawns and earn money during the summer mowing lawns,
but
for
it's
example.
not dividends, interest, or capital gains.
Or rent.
Or rent.
Yeah, you
right.
can't just put...
You can't just shift income to a child, right, and call that earned income.
Absolutely. And in fact, with the kiddie tax rules, you don't want to put investment money in their name anyway, because it's going to be a higher tax rate. That was the old, back in the day, you used to put a big investment account for the kid. IRS picked up on that pretty quick.
Yeah.
So with regards to the earned income, if they have some earned income, they can put money in a traditional IRA, which is deductible, or a Roth IRA. Now, Joe, you and I both know the Roth is a better deal.
Absolutely.
The Roth grows tax-free for the entire existence. When they retire and pull it out, the earnings, everything is tax-free. So I have a good example of this. My very own daughter, college student, playing soccer in college. Last year, worked all summer doing Instacart shopping, made a good amount of money of earned income. First thing she said was, I want to invest. Smart kid, right?
Sure.
Gets it from her mom for sure. So what she was able to do, she was able to put $5,500 in a Roth IRA, and she's super excited because that money's going to grow. It's going to be there.
And she was at the lowest tax rate you can possibly be at. That's the whole point. If you can put money into a Roth, you're doing it off your own tax return. It doesn't hurt the parents anymore because, as Ben said, the exemption is gone, right? So especially if you have a higher earning income family where you may not qualify for a Roth IRA, it doesn't mean your kids don't if they have earned income and are able to do it separately.
Absolutely. Put them to work. Pay them a wage. If they're working at your office during the summer, pay them a reasonable wage. You've got up to the $12,000 plus standard deduction for them, so they can make that much and not really pay a dime of tax, other than Indiana gets their little slice. And then you can put your $5,500 in that Roth, and it'll grow for the lifetime. And with, as you know, time value of money.
It's a beautiful thing.
It's a beautiful thing.
Hey, Ben, we really appreciate you having in. If you want to know more about Ben and how we work with Estep Doctor and Company and how he works with the Financial Enhancement Group, just get signed up for a Next Steps meeting. We work and collaborate with your CPA or with part of our CPAs, and it's just a pleasure to be able to work with you, Ben. You've helped make us smarter and better.
Thanks, Joe.
Hey, have a great day.